Hey guys, welcome back to the channel. Let's deep dive here into the highlights from last Friday's CFTC-COT position report. We saw non-commercial hedge fund traders coming in and buying in size across the ag complex, corn, soybean, soy meal. In fact, this is the largest net inflow of the ag markets, the largest weekly inflows we've seen since last October. Huge inflows on the managed money side, snapping up corn, soybeans, wheat, soybean oil, and meal. Funds bought more ag futures through the end of last week as the macro mood started to remain supportive. Also on the heels of the weaker U.S. dollar and bullish April seasonal headwinds giving these markets some traction. So funds are back in buying mode following a lot of tariff anxiety in April. Let's deep dive into the data. So if we look at the COT data here, going to corn, huge net change of almost 80,000 contracts last week. We can see this through the data that's published each week. How do we arrive to 80,000 contracts? Well, we can see that funds added new longs to the tune of 49,000 contracts while also liquidating 27,900 contracts. That is two instances of bullish posturing. You add those two together, that's your net change of almost 77,000, taking the net position from 92,000 to 170,000 contracts. Soybeans, big change, flipping from net negative, net short to now net long in 1 week period. Why? Funds bought 31,000 contracts. Funds liquidated 51,000 contracts. Net change of 82,000 contracts. Flips them from net short, 34,000 contracts, to net long, almost 48,000 contracts. That is showing some conviction here as we enter into a favorable seasonal time frame. We also see the net position continues to be heavy net short in both soybean meal and also wheat, but we're starting to see that net position decline from that net short to a net positive long, and that's what we're going to be eagerly waiting and anticipating for this week's COT report. Let's dive over into the seasonality here. We've got data going back to 1959 using our proprietary Trend Insider software. You can see the data sets. Here is green. Here is green in 2025. The other data points here, last 10 years in blue, last 20 years in yellow, and then going back 60 plus years in red. You can see the overall trend here encompassing all of this data has been higher until we typically find a seasonal top into around that mid-June timeframe. This is going to be corn. If we look at soybeans, same scenario. We're looking to ride a trend to the upside into the midsummer months. And then if we look at wheat, you can see the same thing here, a little bit flat, but overall looking for a move higher. And this is coming on the heels of record or near record short positioning or extreme short positioning. Price through the lens of technicals, also somewhat muted as well. So we like these trade setups here. We're going to come down, give us some more data here, percentage positive months, monthly average performance. So we expected weakness in really January, February, March, and then we're looking for a strength here into April, May, before you then move into what is a very bearish time of the year for the ag complex. Now, there are multiple ways traders can take advantage of these, whether you trade futures, options, or stocks. The obvious play is to trade corn, soybeans, or wheat futures or options on those futures. ETF and equity traders can trade the underlying ETF. This is Soybeans, SOYB, that tracks soybean futures. You also have corn, the ETF that tracks corn futures, CORN, and then you have wheat, WEAT, the ETF that tracks wheat futures. Okay, so if we look at each of these and start breaking them down, I'm liking to look at ones. I prefer to look at markets that are fundamentally cheap, also cheap from the lens of technical analysis, i.e., I'm not interested in buying all-time or breakout highs or selling all-time or breakout lows. What I will be watching for are base out here at areas of longer-term demand or support and look for low-risk entry points. Now, if you want to participate in this trade setup or this trade theme, in what we feel warrants some exposure due to the inflationary environment that we are in and will likely continue to be in. Commodities such as agriculture should benefit, and you could buy a basket such as DBA, the DB Agriculture Fund, which encompasses not just corn, soybeans, and wheat, but also markets like energies and also softs like cotton. This is a quick glimpse for you here and the exposure of DBA. You can see about 15% to coffee, 13% to cocoa, 13% to cattle. Here we are, corn, soybeans, and wheat with about a 10 to 11% exposure respectively. So about 30% there in that ag complex, about a third of the fund exposure to the ags we just talked about. Sugar, hogs, cattle, and cotton also round that out. And so this is another alternative here that you can consider to add commodity exposure to your longer term portfolio. So this is not a day trade play. This is going to be a play that could or should last into about June, maybe July, depending on the fundamentals at hand. But we like where price is now relative to seasonality and watching the smart money flow come into the market. So keep this one on your radar. And if you enjoyed this video, make sure to like it, give it a thumbs up, and we'll see you on the next update.